When we go to the next concept, which is dividend, this is actually a very interesting concept. And the use of this concept, you're going to see in C corporation the distribution, in partnership distribution, everywhere. Whenever you have, typically in C corp and in S corps, this concept will be applicable even there. Okay, so we're not going to be repeating this concept when we're going to take C corps and S corps after this. Now see, how does dividend become taxable? And you also saw that in Form 1040, they want you to specifically tell you what is ordinary dividend, what is qualified dividend. So we have two questions here. What is dividend? What amount of dividend is taxable in the US? And what makes a dividend a qualified dividend? What is the advantage if a dividend is a qualified dividend? Okay, so these are questions that we're going to answer now. Now see, let me give you a scenario. Okay, let's take a situation here where we have Ankita and we have Kannan. Okay, let's say we have Carson. Let's say all of you, right? Let's say we have the 1 second, I said quickly, right? So what's happening? All of you here, we have, let's say, 10 people. All of you here, you guys made a C corp. Okay. So a C corp was made. And now what happened? We said that, see, each one of you, we gave, let's say, $1,000. So we make a C corp. I think, just give me 1 minute, guys. Let's say 10 people, they invest. How much? They invest $1,000. And now we have $10,000 in the C corp. Now C corp starts working. And now when C corp earns, let's say out of this $10,000, they earned $2,000 in year 1. And then again, $3,000 in year 2. So what happened? So let's assume all of you, when you're pursuing CPA, you decide that we're having a bunch of 10 people. Let's just all decide to have a firm. So one of you who's already a qualified or know somebody there, what you do, you make a firm and then you start floating a business. And you think that's going to be a great job. Okay. So what you do, 10,000 you invest. And in the first 2 years, it was a super success. You get $5,000. Okay. So now what happened? Now you have $15,000 in your kitty. Now, each of you who qualifies for a paper seems to drop out. So slowly, people who are actually doing the work, they're slowly dropping out because they're getting better jobs. So when they're moving out, now the sales starts dipping. And maybe in year 3, you run no profit, no loss. Okay. Now think of a scenario like this. Now you want to introduce and you want to help the other people because other people are getting restless, because you've not withdrawn this money from the business. The business had 10. There was a profit of 5. This profit was never distributed to the owners because you had big plans. Now you want to let the people know that they can take money out. So what you do, you start giving money back to people. So what do? You have original investment of how much? You had original investment of 10,000. You earned. So when you do FAR, we're going to call it contributed capital. So this is the money that the business started with. And then the money earned by the business was $5,000. So what you do, you have now a kitty of $15,000. Year 3 was no profit, no loss. People started getting restless. So what you did in year 4, you distributed $4,000. Now, C corporation is doubly taxed an entity in the US, which means when the company earned 3,000 and 2,000, the company paid tax on 5,000, right? So the company earned the C corp, the company that was formed, they paid tax on $5,000. Now, when this money comes to you, this money will be reported as dividend income in your books. Why? Because this money was an earned money. So the money which is an earned income from the company's perspective, whether it is current, whether it is past, this comes to you and the IRS says, please pay me tax on this figure. So what happens? This money in the hands of all of you, let's say there were 10 people who left, all of those who remained, they will get dividend and this money will go in their Form 1040 Schedule B as dividend income. Now, what happened in year 5? People have started going very, very impatient because there is no business. So what happens? They distribute another 4. Okay, giving you a feeling that the business is doing well. Tell me what is the tax impact of this 4,000? Everybody, tell me what is the tax impact of this $4,000? You are the recipient. Okay, so IRS comes and asks you, pay me money on this 4,000. Would you agree to do that?
This is return on capital, right? The second one is the return on capital. The first
Kannan,
one is
please
the
write your
payment.
answers. Okay, right. Write your answers in the chat panel. I will ask you to unmute yourself.
Sure,
Yes.
sure.
No, see, the second one cannot be fully return of capital. Write your answers in the chat panel, guys. Okay. If you have a question, put it in the chat panel. I will unmute you when the time comes. Okay. See, this 4,000 is not totally ROC. Yes, some of it is ROC, right? But this will be broken into 1,000. This 1,000 is dividend. Yes, good question. This 1,000 is dividend. Why? Because this money was earned by the corporate and it is distributed to you, and it's double taxation in the US. So once the corporate pays tax on it, and then when you receive it, you pay tax on it. But then the balance $3,000, the moment you get this money, you say, hey, this is the money I put in. Why should I pay you tax on the money that I put in and taking it out? So the IRS says, yes, you're correct. So this is actually a liquidating dividend. This is a dividend that you get because the business is getting liquidated. We also call it the return of capital, the ROC, which is return of capital. So this dividend income in the hand of the shareholder is taxable, but return of capital is non-taxable. So what you do, you had 15, you exhausted 8, and then in year 6, business wrapped up. When the business wrapped up, what you did was you distributed. So what was the money that was left behind? 7,000. You distributed $10,000. First of all, tell me, how can you distribute $10,000 when the business already had 15 and the business spent 8 already? How did you not have 7 and 10? So that's the first question that I have. And second, tell me, what is the tax treatment of this $10,000? So two questions. First question, do you think there's a possibility that the business can give you 10, not 7? If yes, how? That's the first question. Second question is, what do you think is the tax impact or should be the tax impact of this 10,000? So if you are the person who's receiving this 10,000, how much tax would you be willing to pay and on what figure? Question 1, do you think it's possible? Give me yes, no. And if you say yes, okay, this is good. So this is 7,000 and we know this 7,000 has to be return of capital. No, but there is no additional earnings now. Right now, is there any additional earning? Yeah, that's a very good observation. We'll talk about it. But how is there an additional earning? Tell me that. The business stopped. There was no business that ever moved in. So where will this additional earning come from? Anybody? There is no money that business made. Then where would this additional money come from? And the next thing is, what about this 3,000? Where did this come up from? Suddenly? Any idea, guys? Think. Where did this extra money come from? Very good. Who is this? Yes, Kat. There must be assets whose value increased. So actually it's a chain flow. This 3,000 actually would have first become income and then this income becomes taxable. Okay. But let's just assume that the entire money got distributed in your hands. So how will you tax this? You say, okay, now see, this is definitely the money that the corporation would have earned. And instead of paying tax on it, the corporation gave me the money. Now, this money will now not be treated as ordinary income. It will be treated as capital gain in the hands of the recipient. Because the only way this money would have been earned is if the capital assets would have appreciated in value and if those assets are directly being given to you rather than the money. So when this happens, we say that, see, anything which is above the entire base of the company, so the entire investment has got recovered, even then if the shareholder is receiving some money, we don't call it return of capital. We say it's a capital gain which the government is Mitali, I could not understand your question. What is reinvestment? Reinvestment of 5K? No, no, no. No. So, Mitali, are you trying to say that it's the 5,000 that got reinvested in the business? No, but then that is interest income. That income would have been paid and booked as earned income by the investor, isn't it? No, so it's not that you've kept it passive and now you're getting interest income. Generally, what happens is the corporate will start giving you assets. And when the asset or the receipt that you get is more, so the value of that asset is gone up. So we say that, see, this income actually should have been taxed in the hands of the corporate. Since the corporate is not paying tax on it, you are going to pay tax on it, but how? Not as ordinary amount, not as ordinary dividend, but as capital gains. So with this, we establish common concept which is going to be relevant to us even when we are doing C Corp, because then that becomes the the payer, right? You are the recipient. So now we're doing it from the recipient's perspective. When you do C Corps, you'll be doing it from the payer's perspective. So what we see, okay, till the amount the money is being paid out of retained earnings, which may be either from current profits or from past profits. So in my example, that till the time the entire 5,000 was exhausted, the money came from earned capital of the business. So basically, we say it is the money which is coming out of earned capital, not contributed capital. So this money, when the recipient gets it, it will say the recipient will book it as dividend income, which will go in the P&L, and the person is going to be paying tax at normal income tax slab rates. But the moment the company exhausted the entire 15,000, in my example, after the first installment payment of 4,000 as dividend, and in the next, the moment 4,000 was paid, we took 1,000 out and we said this was return, this was dividend income, and the balance 3 became return of capital. So this balance 3, which came out of contributed capital from the company's perspective, would be booked as return of capital in the books of the recipient, and it will not be taxable in the hands of the recipient. You would not book this money in the P&L. You would book this money as a reduction in your investment. So think about it. If you're an investor, when you bought the shares of the company, you would have passed the journal entry, investment account, debit to bank, isn't it? You would have passed investment to bank. How would you doing? You're simply reducing it. Okay. So you're now booking cash. You're not going to book dividend income. You're going to reduce this investment. So remember, this money, if it is return of capital, this is going to be a reduction of your investment in the balance sheet. So your asset gets reduced, but your dividend income is not being taxed. So this is non-taxable. But the moment the company has exhausted both the earned and the contributed capital, and the base in the company has become zero, still then, if there is a distribution in the hands of the shareholder, this is termed to be a deemed capital gain distribution. And this money will be taxed in the hands of the recipient at capital gains rate. So you're not going to book it at ordinary income tax rates, you're going to book it at capital gains rate, which is Schedule D in the IRS. So it's one fundamental concept which is going to run through in every topic where this has relevance. So it's important that you understand it conceptually. Is this clear? There are other concepts like, one second. Is buyback of shares treated as capital gains? When I'm buying back, so in the IRS, are you talking about, Kandan? So when I'm buying back my shares, no. So but see, buyback of treasury shares is in the hands of the company, right? When the company gives you shares, you are it's a liability for the company. Where is there a capital gain? For the shareholder, if the company buys my shares back and I make profit which is above the money that I paid, that is capital. Yes, in the hands of investor, it is capital gain. Because it is sale of shares, right? Whether the company has bought it or anybody else has got it. I paid 100, I got 150. That recipient may be the company, may not be the company. It is a sale for me. So it is always capital gains if I have held it for more than a year. That's the rule for capital gains tax in the US. If anything is held for more than a year, it will be treated as long-term capital gain. Less than a year, it is short-term capital gain. Now, So, what kind of dividends are taxable? What kind of dividends are partially taxable? What kind of dividends are non-taxable? That's what, so this is what we spoke about, right? So, when I talk about dividends, we say, okay, general rule, any amount that I receive from accumulated profits or current profits, that means out of earned capital, is taxable in the hands of the recipient. How will I tax it? The money that I receive will be offered to taxation. If the company does not give me money but gives me property. Now, see, general rule, when you now go to C corporation taxation, you will call this non liquidating distribution. This is a distribution where the company is not getting liquidated. I'm paying you something. So you're a shareholder. You gave money to me. I'm giving that money back to you. And in that event, we are not liquidating. So it's not the final distribution that you're receiving. So if I give you cash, you pay tax on it as dividend because I have already paid tax on profits. It's double taxation. So you also now pay tax. If I give you a property, I'm going to call it as a property received on fair market value, on the date of receipt at fair market value. Now, this is important. What is a qualified dividend? Now, first of all, what is a qualified dividend? It's a dividend which is received from domestic corporations, companies which are registered in the US, also qualified foreign corporation. There are certain norms. We're not going to get into details, but general rule, if these are companies who are having their base in the US and the money that the company is earning is typically being made in the US to make, then we say that, okay, it is being paid by a entity which is eligible. And the person who got it did not buy it just to make quick profit, buying it today and selling it tomorrow. So what we said, the taxpayer must hold the stock for 60 plus days during the 120 days beginning. So what we're saying is we take a window 60 days before the dividend distribution date, 60 days after the distribution dividend date. In this period, you must have held on to the stock for more than 60 days. If that happens, then we say that, okay, you're a genuine investor. You did not make a quick buck out of some kind of an insider information. So any dividend is dividend and taxed at ordinary income tax rate unless and until it is paid by a qualified domestic US corporation or eligible foreign corporations in the US. And the investor must have held on to that investment for at least 60 days in the 120 days period starting 60 days before the dividend distribution date and 60 days after the dividend distribution date. Also, if for some reason the company is paying some of your personal expenses, you're an employee, and in that case, that extra money that the company is giving you, even though it is not being termed as dividend, I'm going to treat it as deemed dividend. Because I was not supposed to pay your child's fees. I'm not supposed to pay for your living expenses. If I'm paying all of that, then basically I'm paying you money back as a shareholder, and that money is taxable in your hands as a constructive dividend. So general rule, money paid out of accumulated or past profits or current profits is taxable at the rates which is a fair market value on the date of the money, the day when you receive the money. And the benefit of a qualified dividend taxation rate is what? Since you've already taxed the corporate once. Imagine this, right? The company has already paid tax on $5,000 in my example. So now we are reducing the tax impact because I don't want you to be paying tax again at 37%. Why? It is going to the incentive for the shareholders to buy in corporate bonds would reduce. So in order to prevent that friction, we say, okay, if it's a genuinely US listed company or some eligible US corporate, foreign corporation, then if you're a genuine investor, if it's a qualified dividend, then for most of the taxpayers, it becomes 0%. For some, it becomes 15% taxable. Even at the highest rate, it cannot be taxed at more than 20%. So that highest tax slab of 37 goes down to the highest tax slab of 20. And for most people, it is taxable only at the rate of 15%. If you're in a very low interest bracket, low income bracket, it may even be 0% for you. So what is qualified dividend? Something which is being given by domestic US corps and eligible foreign corporations. And if the shareholder is holding on to that money for those shares for at least 60 out of 120-day period. Second, what is the benefit? The benefit is since this money has already been taxed once in the hands of the C Corp, now if you're eligible for both of these criteria are met, I will not tax you this money at 47%. At the max, it is 20. Minimum it can be 0. On an average it is 15%. So why is it maximum minimum? There is a rate. I'll show you how that rate chart looks like. But you're not supposed to be memorizing those income tax brackets and stuff. So I'll just tell you why we say it is 0, 15 and 20%. Okay, we have a question. 1 second. Instead of dividend, if the company chooses to buy back share, if instead of dividend, if the company chooses to buy back share, okay, okay, you will see, Kandan, okay, I get your question. If you're saying that the company will not pay dividend, the company will buy back the shares. And, but see, what is the benefit for the company? What is the benefit? For the shareholder, it is the same thing. What is the benefit for the company? The company which is paying tax on, what is the benefit for the company is paying tax on the earnings, right? How it is utilizing that earnings and paying you dividend or convert, that's immaterial for the company. Kanan, are you able to understand what I'm saying? For the company, it makes no difference because the tax incidence is on the earnings. It is not on the distribution of the earnings. So for the distribution of earnings, when you do gap, you will see it's just the reverse, right? You are just going to reverse retained earnings and you're going to make it equity capital. That's it. Which is also, in dividends, you just reduced the retained earnings, isn't it? Tax wise, there is no benefit that the company gets. But there are other reasons why company declares a buyback. Okay. What's the tax-free dividend? Now we know this. If it's a return of capital, which means the company has exhausted all its current and past profits, and still if it is giving you dividend, then we call it liquidating dividend, and that dividend is tax-free in the hands of the recipient. When there's a stock split, I had 10 shares, I split it in 100 shares, tax-free. When I give you bonus shares, general rule. So stock dividends is actually bonus share. You had 5, I'll give you additional 5. But if you had 5 and I gave you additional 5 as dividend, general rule it is not taxable. But if you had the option that instead of taking extra shares, you may take money. It is immaterial whether you're taking money or not. The fact that the company gave an option to the shareholder that they could exercise it in cash, that itself means there's a value that I can put to these stock dividends, and then it becomes taxable at fair market value on the date of receipt. And it is so this is very, very important. It doesn't matter whether you actually ended up exercising the option or not. Okay, life insurance dividend. What's life insurance dividend? I take life insurance policy, I pay you premium, and you pay me back my premium. It will not be taxable. This is a concept that we're going to learn when we're going to do S corporation. Now, see, S corporation is single taxation. Okay, 5 people form a S corp, a small corp, and whenever the S corp generates money, I report that money in my books and I pay tax on that money. So when I'm earning that money, I've already paid tax. So when the money again comes back to me in form of dividend, then I don't have to pay tax again because I've paid tax once when the company generated the money. So that's the reason whenever the S corp gives you dividend, you don't pay tax on it because S corp is single entity, single taxation entity, because it's a disregarded entity, or you call it an entity which is just for information purpose, a flow through entity in the US. So any dividend that an S corporation distributes, if you are a shareholder, you don't pay tax on those dividends. Okay, but more on this when we actually go to S corps. What about capital gains? So one is taxable dividend income, tax-free return of capital. Capital gain distributions is when there is no earnings and profits and no basis. You had no investment. You had no, all the money that you put in has come back to you. Still, you're receiving money from the corporation. That happens if the company has generated some capital gains and it is distributing it to you. In this case, it is going to be taxed in your hands as capital gains. Okay, it's a simple concept. We did interest, taxable, tax-free, Series E bonds. Then we did dividends, taxable, tax-free capital gain distributions. Okay, this is just for your information. They're never going to ask you questions talking about the tax slabs. Now see, this is how the capital gains rate is again equal to your dividends rate also. So not all dividends, only qualifying dividends. Okay. So what do we say is this: the moment you are a US entity distributing dividend and the recipient gets dividend, and also if you have held on to those shares for a long period of time, then we say that, see, in that case, you don't pay tax at ordinary income tax rate, depending on how much money you're otherwise earning and what's your filing status. We define different tax slabs. The tax rates are 0, 15, and 20. So this is the highest tax slab at which capital gains or qualifying dividends can be taxed in the US, much below the slab rate of 37%, which is the highest marginal tax rate for individuals in the US. And if you see, depending on the amount of income that you're earning, okay, so the higher the income is, the higher becomes your tax that you want to be paying. Married filing jointly will have the most success or the least amount of tax incidence for capital gains and qualifying dividends. For single, it's the highest. Married filing separately is half of married filing jointly. Head of household is somewhere in between. Remember, if it's a short-term capital gain. So here when we say capital gains, we're talking about long-term. So it's only long-term capital gains and qualifying dividends, which would attract 10, 20, or even 0%. But the moment it is short-term, you're going to pay tax at highest income tax rate. So whatever, add slab rates. So your highest marginal tax rate could be 37%. So remember, LTCT tax rates highest 20%, same with qualifying dividends. Now you can understand why they wanted to separate your dividends and tell them how much is qualified and how much is ordinary. The moment it is qualified, they would also check it from the company who's paying you that dividend. See how much of it is materialized. Okay? So this is as far as the capital gains tax rate is concerned. Generally, the payers of dividend will send the taxpayer a copy of, this is what I have paid, a form 1099 DIB listing how much is ordinary, how much is qualified. Okay, let's look at this question. Example 12. Emily bought 50 shares of stock in year 1 for $500. In year 2, she received a return of capital of 100. She received an additional return of capital of 50 in year 3. What must she be reporting as long-term capital gains on her tax return for year 3? So see, in year 1, what did you do? You pass a journal entry, investment account debit to cash. How much? It's $500. You can continue writing your answers in the chat panel. Okay? This was year 1. Then what you did? In year 2, I received my money back. The company did not pick off and I was not able to earn anything. So what I did, it's a return of capital and I need to call it a liquidating dividend. And instead of, so I know I got cash. There's no doubt about it. How much cash I got? I got 100. And the credit would not go to dividend income because it did not come out of earnings and profits. It came out of the money that I invested in the company. So it's return of capital, not taxable. So this is not taxable in the hand of the recipient. Now in year 3, the company again paid me back. So if I look at my balance sheet, I started with investment of 500. I reduced that investment in year 2. Now I'm with 400 as an investment. Then in year 3, I again got back $50. That means my investment becomes 350. So in year 3, will there be any capital gains? Will there be any capital gains in year 3? You will have to exhaust that 500 completely before you can book anything in capital gains. Till the time I am getting earned money, I will pay tax. Till the time I'm getting back my investment, I will not pay tax. After the entire investment has been recovered, then if I get the money, I will pay capital gains. So what do? I pay no tax. No capital gains. Why? Because I still have $350 left. My investment has not become zero. So how much long-term capital gains will be reported? Zero. Are you guys able to understand? Are you guys able to understand right? Everybody. See, I'm not getting a lot of answers, and that's the reason I am choosing to emphasize and ask you if you are able to understand. Till earned capital, if I get, it's dividend taxable in my hand. Till return of capital, what I get reduces my investment, no tax impact. After that, so once, let's say after this, the company gives me another $500. Then, so I'm just continuing this example a little bit more. Now the company pays me 500. So what will I do? So in year 4, I received how much? I received 500. So I got cash of 500. The investment that I had of 350 would come down. And then anything extra that I receive will be capital gain of 150. Okay, Kannan, did you realize you went ahead of the question? You're now assuming that the company paid you back $500 without any information. You have gone ahead of the question. It's not that you did not understand the concept. What you did, you assumed something in the question. That's what happens when a person is very experienced, or when a person is having a mindset, is always thinking ahead. Don't cross the question, be with the question. Don't assume anything in the question. Okay, now I have a chocolate question. Let's see how many of you answered this correctly. Okay, let's see how many of you answer this correctly. It's a very good question. If you understand this question, then you've understood this concept really well. It ties up the full concept with one question alone. What is the call of the question? What are Miss X's ordinary dividend income and the return of capital due to this distribution? So, whatever money is being received in this scenario, you have to tell how much of it is ordinary, how much of it is return of capital. Corp A, which is a calendar year C Corp that began conducting business 18 years ago, had accumulated earnings and profits of, so the moment you see a question like this, start from C Corp perspective and the shareholder perspective. And in your mind, tell yourself, I am a shareholder. I am a shareholder. I'm not a C Corp. And I'm supposed to be receiving some money, and I have to tell the IRS. So when the company gives me money, the company gives me 1099 DIV telling me this is ordinary, this is qualified. I don't have to put my mind to it. And the same thing the company has to give to the IRS also. Okay, what I have to do is I have to take that and put it in my form 1040. So what is my income and how much of it will be taxable, how much of it is not taxable. So I need to know how much did I receive, how much will be taxable, what rate will it be taxable, how much will be not taxable. That is what I want to understand from this question. If you are doing the question and if you do it before I complete, please write your answer in the chat panel. I will know how much you are understanding in the class. Okay, so I started my business 18 years back. Who am I now? I'm C Corp. I had on January 1, I had 26,000 worth of accumulated earnings and profits. On April 1, so when was this? This was Jan 1. On April 1, I distributed $40,000 in cash to Miss X, who is my sole proprietor. So this is a single person company, or a one person company as we call them in India. So it's a single member C corporation. Is it possible? The answer is yes. You can file some paperwork even if you're single and claim that you want to be taxed as a C corp. So how much did you receive? You received $40,000. C Corp had earnings and profits of $4,000 for the current year. Okay, so this is actually cumulated earnings and profits. And then you had current year earnings and profits, and this amount was $4,000. Miss X had an adjusted basis of 18,000 in her stock before the distribution. So when I looked at Miss X's balance sheet, the amount of investment showing in the balance sheet was $18,000. Why is this relevant information? Because the moment it exceeds 18, I know that it is capital gains. It is not return of capital. So now I have full data available. The company paid me 40, and out of this 40, so company paid me 40. Out of this 40, 30 came from earnings and profits, past and present, and 10 ideally would have been return of capital. I am the sole investor in this company. So why would I call 10 as a return of capital? Because when I do this, I'm going to be paying tax on 30,000. Now, nowhere is it written whether it's a qualified or a non-qualified dividend. Assuming it's a qualified dividend, I would say it is maximum tax at 20%, generally tax at 15%. What is non-taxable? $10,000. Why? Because it is non-taxable return of capital. So when I get this money, I will book cash account debit. How much? $40,000. And then I will book dividend income, which will go and rest in my P&L of $30,000. And I will pay tax at either 20 or 37%, depending on whether it's ordinary or qualifying. And the balance, I will simply reduce my investment. How much? 10,000. So out of this 80, now my balance sheet will show the investment of only 8. Now, if the company gives me more dividend, till 8, I will not pay any tax. Beyond 8, it will become capital gains. So in my example here, my dividend income is 30,000 and my return of capital is $10,000. Okay, what? Okay, Karsten, Ankita, why not answering? You need not be perfect. We are not trying to judge you at all. Please answer. Because when you answer, you understand where you went wrong. But trust me, you will not repeat that mistake again, ever. Because you did something and now you understood why you were wrong. Don't be passive learners. Carson, I have a feeling you're doing something else apart from taking the classes. Because you're generally very, very active. Okay. No, but answer the questions. I'll understand where you're making mistakes and probably I can give you some pointers. Okay?